Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alcana, along with Brianna Valesky, and we have Ben Carlson on the line. He writes a blog, A Wealth of Common Sense, is a Yahoo Finance contributor. He's worked in institutional portfolio management for his entire career and is currently with the Van Andel Institute, a medical research organization located right here in the great state of Michigan. Ben, how you doing today?
Great. Thanks for having me on.
All right, thanks for coming on. So, give us a little bit of your education and your background in the markets.
Sure. Yeah. So, like you said, I've been in the institutional side for a little over a decade now, managing mostly pensions, endowments, foundations. Went through the pretty standard track of a finance program, and then did the CFA program right out of school. But just yeah, I've been managing larger portfolios, mostly in the state of Michigan. So glad to be on. I actually worked in the Detroit area for a while, so I'm glad to be on your show. But just I've kind of been honing my skills over the years, spending a lot of time. Most of the education I get is actually reading, and not technically. I'm from the education side, from the CFA and that sort of thing. So
Okay, and tell us about your current role at Van Al Institute.
yeah, sure. So we manage an endowment fund. Bandel actually has an endowment fund that the proceeds of the fund go to help cancer and neurodegenerative medical research. So very, very long-term, big picture medical research, and then the portfolio actually funds the operations of the organization.
Okay, all right, and so you've never been on the individual side, right? You've been pretty much on the investment consulting for large funds and or groups, but does it really differ that much for? I mean, if you're looking at a long-term time horizon, does it really differ much from the average investor?
Yeah, not. I mean, there are some minor differences, of course. I mean, a lot of the charitable portfolios are set up to run forever, basically, as long as they can continue to get donations, and then they can continue to keep the investment, the returns going, as long as they're not spending more than they should be. But I always like to say that it's basically just a few extra zeros that institutional investors have to play with. So regardless of the size of the portfolio, you can't really reinvent the wheel. Those same principles still matter. Every portfolio has to be set up to take into account their risk profile and time horizon, before putting it together. And I think a lot of institutions actually run into problems because they try to reinvent the wheel and get too clever. So I honestly, when it really comes down to the main principles, it's really not that different when setting up a portfolio, because everyone has their own circumstances, obviously, but those main investing principles are span across all portfolios.
And for you, I mean, there's expenditures that that you have to pay out for the certain research projects, the universities that are doing the work and stuff. So you have to figure out, you have X amount of money, you're going to have to pay out X amount, on a monthly or quarterly basis. So and you don't want to dip into the principles, so you have to maintain the principal value. So you're not really getting new money. I mean, you have a standard endowment right now that you're working with. You don't really get like new money, and correct, or do you?
Right. Yeah. I mean, we do get some donations, but yeah, for the most part, you're right. We're managing a pool of capital that doesn't change. And like in some ways, we're kind of like a retired investor that needs to spend, but also has many years still to grow their capital. So yeah, you're right. We do have to have some of that short-term liquidity to meet those short-term needs, but then we have the very long-term we're looking at. So it is kind of a balancing act.
Yeah, I was going to mention it is similar to a retirement account, and the reason I mentioned that is because the mutual funds and these money managers. Like if you decided, okay, I'm switching over to ABC Money Management, and I'm going to bring you $1 million, they're going to put that money right to work right away, aren't they? I mean, chances are, if you're in a big fund, I mean, uh, that's what you're subject to, and you're also subject to the redemption, right? If people get scared, they want to pull their money out of the market. I mean, is one danger of it, investing in this sort of fashion.
Yeah, no, I agree. There, a lot of people like to put a lot of the blame on the manager because it's always easier to blame someone else. But the investor behavior definitely, is front running the manager behavior. So if investors are pouring in money after a manager's had great performance and pulling out after they've had terrible performance, that's just going to amplify the moves by these managers. So a lot of times the investors are what's causing much of the problem with the actual active managers.
All right, now I think I have the answer to my own question here, but how much is how much of your approach is based on fundamentals?
Yeah, well, I'd say a decent amount, but I think that it's really hard to base an approach exclusively on one factor, um, because there's so much that goes into moving the market. So even if you say you're a fundamental investor, you can't just ignore everything else because the way I look at it, there's really three main factors that move the market. So you have your fundamentals, your trends, and then obviously your psychology or the sentiment of the market. So I think um, it sounds good to try to box yourself into some sort of style, but I think that especially in today's world where things move so quick, you have to be at least cognizant of everything else to understand what's going on out there.
Okay, so then you do look at charts.
Well, I mean, I think even if you're not a traditional technical analyst, I think you still have to pay attention to that stuff because really, technical analysis is just about risk management and defining risk. So even if I'm not a chartered market technician, which I'm not, I did the CFA program. I don't think that you can just, let go of technical analysis and say it's worthless. It still has. I think every discipline can be used for all investors. It just depends how you use them and what you're looking at. But I don't think that an investor has to exclusively look at one side or the other. I don't think that's necessarily how you should go about it.
All right, so sitting at your desk and looking at your computer, I mean, are you looking at any charts right now or any quotes? I mean, I know you have a long-term time horizon. Is it? I mean, if you came here and you looked at my workstation, you may like, oh my gosh, you may think you're like in NASA or something. But I mean, are you looking at any charts right now?
Yeah, well, I mean, I have I have the Bloomberg terminal, so it is funny that anytime you ask a fundamental analyst to pull up some information on the stock, the first thing they do is pull up the chart, obviously. So yeah, I mean, I think it's impossible not to look at the charts again, just to see where things are going and put things into context because you can look at any weekly, monthly, quarterly data um, at any specific point in time, and it's probably going to be useless without context behind it. So you have to kind of see where the trend of that data is going, and not exactly just the year over year, quarter over quarter change, but how what's the overall trend longer term. So I don't think that necessarily means you have to use specific technical analysis, but you still have to be aware of this stuff.
Yeah, it's kind of a self-fulfilling prophecy, and that's what Dennis and I talk about a lot on the show, even for our shorter term or mid-range trading. I mean, there are historical levels when you look at a chart. I mean, obviously, you look at the S&P over the last three sessions. 88.75 was the all-time high on Friday. It was the all-time high on Monday. We crept up to 88.50, overnight. So there are times, looking at a minute tick chart, is something that maybe I did in the past, but now, it's just all noise. So you kind of do your fundamental analysis, and then let's say you look at stock ABC and you're interested in purchasing it over a period of time, then you might go to the charts and say, here's a preferred entry level.
Sure. Yeah. Yeah. I think that the way that they usually say it is fundamental analysis tells you what stock to buy, and technical analysis tells you when to buy it. Basically, I think
Yeah,
that's kind of
I
how
might
it
have.
works usually.
Do you mind if I use that one?
Sure. I'm sure I stole it from someone else too. So go ahead.
Okay. All right. Let's just talk about the market. It all had a nice year in 2014. Really, it was the two rallies off the the basically the 1950 level in the S&Ps. We briefly touched that with the Ebola lows, and then mid-December. If you thought the rally off the Ebola lows was quick, the rally the second time in December was twice as quick. And here we are lurking at new all-time highs. what's your outlook for next year? Are there any emerging trends or sectors that investors may want to keep an eye on, or is there any ones that they may want to avoid?
Yeah, that's interesting. It is. Investors have almost become conditioned at this point to expect those quick V-shaped rallies,
Hmm.
and it seems like they're getting quicker and quicker, which is pretty interesting. Um, but eventually, obviously, that's going to come to an end, and no one really knows when, obviously. But I think that when it does happen, investors are probably going to freak out because, um, again, they've become so conditioned to just expect that. And every time we get a 4 or 5% drop, you can feel the investor sentiment really just turn on a dime. And so it is an interesting dichotomy. As far as what's going on in 2015 for sectors, my only bet would be that it's probably going to be something that didn't work this year. Um, Sector leadership is very fleeting. If you look at, I actually put together a chart, kind of like one of the asset allocation quotes, where you look at the different outperforming sectors. There hasn't been an outperforming sector for 2 years in a row since 2004 and 2005 when energy did.
Wow.
Otherwise, every single year there's been a brand new sector, and for 7 years in a row, it was a different one that hadn't outperformed before. So it's almost just like a wheel that turns and a new one picks up the next year. So um, I think my only bet would be that it's probably something that didn't work this year.
That's that gives us a lot of choices. Gives us the oil sector,
Well,
yeah, maybe part of the the gold, maybe I mean it's a little bit smaller, but the 3D sector. So that's very interesting statistic. I'd like to take a look at that. So if you had to pick one factor that could really rock this market, and I'm going to throw out a rise in interest rates because that would be the easy thing to say. What thing would really kind of shake the foundation of of a bullish thesis in 2015?
yeah, it is hard to point your finger at one thing. It's actually interesting. People are really worried about rising interest rates, but if you look historically, stocks have done fairly well in a rising rate environment. Every time the Fed has raised the rates in the past, up to a certain level, stocks have actually performed right on their averages. Um, so that it does seem scary, and intuitively it makes sense that stocks will get dinged once interest rates start to rise. But you got to remember, we're rising from a lower level. So I think it really all has to do again with psychology of the market. What is priced in, and what are investors assuming is going to happen? Because really, it's all about a pricing or a mispricing of risk. So if investors are getting too complacent or too overconfident at this point and think something is never going to happen, and it kind of someone pulls the rug out from under them, then I think that's a major issue. So I don't ever think it's one event that can really derail the market. I think it's how complacent investors get with what they think is going to happen.
Okay, and from your site and also talking to you, I know you're an avid reader, and you like to read fiction and nonfiction. I guess let's start out with books that are not on the markets. Could you give us a couple of your favorites, maybe for the year or maybe all time?
Yeah, sure. Yeah, I really like to read investor psychology. Maybe this is a good one for the timing since we're coming to New Year's resolutions, but there's actually a book called Mindless Eating, and it's all about the human psychology of why people have such a hard time losing weight and dieting, and it really crosses over well with the markets, and it's all based on human psychology. So I think anytime you can find that human nature, human psychology element, which is I think is extremely important for the markets, those kind of books are definitely worth reading.
Mindless eating, you said?
Yeah. Yep. So
Who's
one
the
of the
author?
interesting stats was if you go out to eat by yourself, you'll eat something like 75% less food than if you went out with a group of 7 or 8 people, just because of that herd mentality again that we see in the markets.
Wow, that's really, my wife's a physician and she talks a lot about, obesity and, the problems and very on. I'm going to have her pick up this book. This sounds like a really good one. And how about a book or two very specific to the markets? I think there was one by Josh Brown that you had mentioned. Was that on your hit list for this year?
The Clash of the Financial Pundits was one of my favorites for this year. Him and Jeff Mackey wrote that one. I really liked the really behind the scenes tour they gave you because it's very easy these days to really harp on pundits for being wrong all the time, just because they constantly have to have an opinion. And I thought it really gave a good backstory as to how it works and how you should really think about the advice that you're getting from someone on TV or someone writing or someone doing a radio show. And again, understanding where they're coming from and what kind of advice they're putting out and how you should tailor that to your own situation.
Okay. And just final tips for investors going into the new year.
Sure. I think however you invest, and again, this is institutional or individuals that kind of been involved with both. I think you just have to find a process that really fits your personality. I don't think there's any really perfect way to invest for everyone. Every portfolio is the worst portfolio besides the rest of them. So I think just finding a way to find a process that fits your personality and that has a high probability for success that you can stick with. That's my advice.
Okay, are you signed into the chat? And the reason I ask is one of our chatters, Rob Hood, asked if you could post the chart that you were talking about, and I believe he was referring to one about the different leading sectors. So if you get a chance, or do you have a point where someone could reference that chart? Maybe one of your former articles.
Yes, I do. Yeah, I can post it on your chat room. I can
Ah, that
post that article.
That would be great. I really appreciate it. Well, we've had Ben
Yep.
Carlson on, and he is a institutional money manager. He's has a blog, A Wealth of Common Sense, and he had a lot of common sense in our show today. Yahoo Finance contributor, currently working for the Van Aldel Institute in Grand Rapids. Thanks a lot for coming on, Ben. Really enjoyed the conversation. Have a good New Year. We hope to speak to you again.
Sounds good. Thanks a lot.